So you're retired. What do you do now? Oh, some people decide that they want to look at buying a business. All right, so there's this ice cream store that's you like to go to, and you turn to your spouse and say, "Hey, honey, how about if we buy this ice cream store in our retirement, and we'll be able to eat all the ice cream that we want, and make money doing it, and have some fun in that, meet a lot of people, that kind of thing." And your spouse says, "Yeah, that sounds like a good idea. Let's go inquire on that." So you go into the ice cream store and you say, "Hey, you want to sell your ice cream store?" And the owner says, "Yeah, I'd like to sell my ice cream store." Well, if the owners, you say, "Well, okay, so what kind of profit do you make in this place?" "Well, I make $100,000 a year," he says. And and he says to you, "But I want $3 million for this ice cream store." Now, if he says to you he wants $3 million and he makes $100,000 a year, that is crazy. You better walk, not run out of that place. Hold on to your wallet, because he's trying to rip you off. Because that's what's called a PE ratio, a profit versus earnings ratio of 30. It's going to take you 30 years of profit to just pay off the store. I mean, you could do better at putting your money in treasury bonds at that standpoint. But I'm Andrew Adjemi.
And I'm Daniel Adjame, and you're listening to Financial Strategies. Today, we're talking about investing with a crystal ball or investing by contract. That's an interesting story. I like where you're going there. Um, Tell us more about PE ratios.
Well, PE ratios, companies, when you're looking at them, they have the profit versus earnings ratio. And that one that I gave in that example was a PE ratio of 30. And it was that's what's considered an expensive company, an expensive stock. But on the other hand, if that ice cream store owner said, "Hey, I want $500,000 for this ice cream parlor," well, that's a no-brainer. That's a deal. You better write him a check right then from that standpoint, because that's a PE ratio of 5. It's going to take you, in that example, 5 years to pay off the debt, pay off the stock, and then everything after that is going to be profit. So that would be the cherry on top of the ice cream kind of thing, right? So the that's a great PE ratio. And the thing that's crazy is what some companies are selling for right now as far as the PE ratios go. And that brings up a question: do fundamentals really matter anymore? PE ratios are a ratio that is often looked at to see what is a stock. One of the factors that's looked at of what is a good stock. And there's one company out there right now that has 4 digits of a PE ratio, which is crazy, right, Daniel? I mean, that's ludicrous, right? Because a great PE ratio is a single digit. And, if you start getting into 10, 11, 12 PE ratios, those are good buys. But when you get into quadruple digits, that's crazy. That's crazy. That the fundamentals are blown out of the water at that point. And that's what, Daniel, you said earlier in regard to the four dangerous words that people say is, "This time is different."
Yeah, yeah, and with the PEs, something that comes to mind is um, people have drawn a parallel. Actually, yeah, people have drawn this parallel between the 20s, the 1920s, and the 2020s, and how the technologies just changed the world at that point in time, and the demand built up after the war, and we're able to drive everything up. And so, to put it in perspective, PEs on the stock market were about 4 when at the beginning of the 20s, and then they rode up um, to about where they are right now in the market in 1929. And so you know, it's difficult to say that at a all-time high valuation in the markets right now that it will continue to go up even higher with those PEs like you're talking about from here, like it did in the early 20s, 1920s up to 1929. And so we want to paint a picture for people of where the economy is. And why do we want to paint a picture for this? Because we don't want people to make money? No, because you were talking earlier about concentrated positions, and concentrated positions is how you make money. That's how you've made your money, right? You put
Right.
all your eggs into one basket, your business.
Right.
You put it in the business, you spent your time, your energy, your blood, sweat, and tears into building a business. And
Right.
that was a concentrated position. And now you've spread and diversified your wealth now that you've built it up. That's
Right.
what Elon Musk did, Jeff
Yeah.
Bezos. This is what people typically do. And so if you've made your wealth and you're sitting back and you're retired, you need to look, are you too concentrated in a position? Or should you be trying to diversify through different asset classes, different correlations and things like that, so you can protect this wealth that you've built up when we're seeing things flashing these danger signs in the market, these valuations that are ridiculous. We're going to get into the Warren Buffett indicator, things like that.
Yeah. Yeah. This is really uh, crazy times that we're in, and these aspects of what we're looking at today. If you're just joined us, you're listening to Financial Strategies with Andrew and Daniel Adjmi. If you're watching us on our YouTube channel, you see me smiling a lot. That's because all these things we're talking about, I lived these 30 years ago, and so it's all sounded familiar. And that's why I'm kind of chuckling to myself, because it's like happening all over again in a lot of ways. And but you're listening to Financial Strategies with Andrew and Daniel Adjmi. We have a companion piece to go along with today's show called The Hard Lessons Learned in Stock Market History. So the best way to learn is by learning from other people's experience. So Hard Lessons Learned is available to you by calling 800-725-7616. Daniel, when we're talking today about investing with a crystal ball or by contract, I want people in our listening audience to understand that you can make money in the stock market. You can make money by investing today, but you have to be smart about it. You have to be careful about it. There's a lot of people out there today just throwing money at the market in different ways, right? Because between, like you say, using Robinhood and all the different apps that are available, people are taking small amounts of money, large amount of money, throwing it at the market. And this is a supply and demand thing. So the market is going to go up with that. But at some point, it's kind of like a game of musical chairs. As long as the music's playing, hey, everything is good. But should the music stop, well, now we have a difficulty, because now the market starts dropping. There's going to be people without chairs. They're going to be losing money. And then once it starts, it could go the other direction. Now, we're not trying to be chicken littles here with this. We're just trying to help people to understand that you have to look at things in a smart way. You have to make decisions on purpose. You have to know what you don't know. That's why we have Financial Strategies, the radio program podcast, to be able to help you know what you don't know when it comes to finances, because there's a lot of stuff out there. And Wall Street likes to have you in the dark about certain things. So we want to make things clear to you and bring things out in the light so that you can make a smart decision by choice and on purpose, rather than making a dumb decision by indecision or unknowing.
Yeah, exactly. We felt the pain, in the tech bubble crash especially. We felt the pain in there. That was before you had really educated yourself
Right.
on market cycles and history, market history, things like that. And so we felt the pain of that. And what our goal is to do is to help as many people to be defensive, to understand what they have, and to protect themselves. And as we dive more into purpose versus performance, when you would get your eggs lined up properly, when you get the diversification and you're investing for purpose first, as a retiree for purpose first, that gives you tons of opportunity to be able to take advantage of opportunities that present themselves when things like good companies like Amazon not saying it will happen, but it did in the tech bubble, cut by 90%. It came down by 90%. Microsoft took, you know, 13, 14 years before it got back to where it was, right? So you
Right.
could take advantage of things like that when you're invested for purpose first.
Right.
You've built up your wealth if you're in retirement. You've built that up. So let's talk about ways that you can protect yourself,
Right.
generate a decent return, because it's not about having these ridiculous numbers. You know, it's not about the YOLO option guy in it who made the 8 digits, because he put everything at risk. He used ridiculous leverage and could have lost everything. That's what you do for those concentrated positions we've talked about. Um, Once you have built your wealth, that's when you diversify
Right. Right.
so that you can protect what you have and continue to move forward.
Right. Purpose versus performance. And when regarding retirement, again, purpose is so important. Performance aspect can be a part of your retirement plan, but it is not what you base your retirement plan on. You know, when we're talking about purpose versus performance, the whole aspect of stock market, of the stock market and investing and how that all works. It's kind of like this, you know, and I've got this little fancy thing. If you're watching us on our YouTube channel, right, I can, this is pretty cool because I can draw this for you. But, you know, when we're talking about all investments and you have a teeter totter and you have, you know, risk that, you know, on one side of the teeter totter, the left-hand side of the teeter-totter is risk. So we put a 10 underneath that seat. On the other side, there's a 0 that we put underneath. And then, you know, we have the sections. We divide it into 3 sections, with the left section being aggressive, the middle section being conservative, and I'm sorry, moderate, and the right section being conservative. Then we can subdivide those into the same categories from that standpoint. And when we're looking at investments, we have to be able to understand them on this premise, because many times Wall Street, you're listening to Wall Street, and Wall Street's pyramid is within the area of aggressive, with aggressive, moderate, and conservative within there. And so that is the area that we're talking about investing for a crystal ball. You can make money there, but you have to be careful. You have to be smart about it. When we're talking about the other area regarding the moderate and conservative areas on the teeter-totter, well, that area is what we're talking about when we're talking about investing by contract, and where you can have a dependable income, you can have money grow both by growth as well as by interest and dividends. And so we want to bring that across to you so that you'll be able to understand and help you move forward with your retirement. Now, I see that we're going to need to be taking a break here. And with that, we are giving away a book to the next 5 callers, Common Sense Income Strategies by Michael Easom. This book is going to be able to help you understand how to be able to invest for purpose, how to be able to have the money that you need in retirement to retire and stay retired in a stress-free fashion. This is available to the next 5 callers at 800-725-7616. You're listening to Financial Strategies with Andrew and Daniel Adjemi. We have a white paper. We have to go along with this, a companion piece for today's show called The Hard Lessons Learned in Stock Market History. The hard lessons, or the book, Common Sense Income Strategies, and the next 5 callers at 800-725-7616. We'll be right back after this.